Welcome, everybody outside, wherever you are. A warm welcome also in the name of JFD Brokers. And my name, as always, for those type of webinars is Stefan Friedrichowski. Yeah, it's very nice to have you all once again here in those kind of webinars, a little bit more sophisticated, a little bit more driven by mathematics, statistics, and everything like that. But I know there are a couple of guys out which are really interested in those approaches, those kind of trading approaches. Good. Yeah, there are some additional greetings here directly via the chat, which is nice. You might use the chat anyhow for anything you want to know in between. You can use that chat to have a question anytime. Okay, of course, there's already a question. The webinar is recorded, and you will find the webinar tomorrow morning, maybe about 10 a.m. In the JFT YouTube channel, and that is exactly what you might type into Google in order to find that YouTube channel of JFT Brokers. Just YouTube JFT, and then you are directly linked to that YouTube channel. I have not mentioned the date. So we have the 31st of May. So the month is nearly coming to an end. And we have 7 p.m., at least in Germany. Good. Let me talk a little bit about the topic of today, pair trading on smaller time frames. The one or the other might remember that we have had the topic pair trading more or less 1 year ago, a little bit more even than 1 year. It was in April when I started with JFD. It was, I think, the first webinar at all about pair trading. And at that time, we used just the daily data. And it turned out that there's a wonderful example for those kind of pair trades, and that is the two types of oil, WTI and Brent. So, we can trade, or there are two types of oil, and those two underlyings, those two oil prices are highly correlated, of course. And we found out that there's a wonderful idea how to trade that pair. And you see, pair trading means always we trade two underlyings. At that webinar, we developed already a good strategy on D1 base, and it turned out additionally that, for example, if we go for indices like DAX or S&P 500 on a D1 base, then it was not that profitable. And there's a story behind. What we always need is that those two underlyings come together once again, so more or less, so that they don't diverge for a long time. So, for example, DAX goes for a long time up, and S&P 500 goes for a long time just to the south. But the bad thing is, from time to time, that happens. And if we have those kind of behavior, then we get in trouble with our pair trades. Therefore, today we go for DAX and S&P 500, but on smaller time frames, because then the overall picture is not that important. The overall picture, in a sense, like we have right now, or we have more or less since Mr. Trump is the president of the United States. From time to time, we have strongly uncorrelated situations between the two markets. But on the other hand, we have, and we will see, for longer time periods, this behavior that one goes up and the other one goes down, which is bad on D1, but on smaller time frames, we can live with those kind of behaviors. As always, that just for introduction for today, as always, you see already my email address later. I will have a couple of Excel sheets once again. If you're interested in those Excel sheets, just send me an email at s.friedrichowski@jfdbrokers.com. And you can already download the slides of today via the GoToWebinar control panel. Okay, let me go a little bit further. Oh, just there has been a question. There was a nice screen before we started, and I just quickly want to introduce what you have seen there, because that is something which is quite important for me. What you see here is an MT4, okay, but that MT4 has a special meaning, and this MT4 is supervising all the other MT4s, all the different servers. I use a couple of virtual private servers, in total 6. And on each of those servers, they are running about 8 MT4 instances. And in order to supervise all those 6 servers and those in total 48 MT4 instances, I use that new created expert advisor from Peter, because that is communicating with all the others. And if something goes wrong, I can realize it here immediately, which is really nice, because I get all the informations and I get an email if something goes wrong. And if some MT4 loses connection or an expert advisor is not working anymore, all those things come on that one single screen, and that is supervising all the other servers. You see, a lot of strategies, most of them are running on live accounts. A few are in test phase, those with the account numbers 11 in front. Yeah, so that was that screen here. I mean, you might have a need for something like that only if you trade that heavy like I do. But for me, it's really important. So at first, of course, I have to mention the risk disclaimer. We talk about trading strategies. I have to mention it, that finally, when it comes to your own trades, as always, you trade on your own responsibility and liability. But you can use the information here. But your trades are your trades, of course. How do we touch the topic here? So I start with a basic idea, and we go always this webinar for DAX versus S&P 500. So 2 major indices, one for the German market and the other one for the United States. In principle, you can go for any other combination as well. You can go for Dow Jones versus S&P 500. You might go for the Euro stocks against DAX, or against the CAC 40, the French index, or whatever. You have always 2, because it's a pair, and that is a base for everything here. And just to have the idea of that pair trading, or sometimes it's called spread trading, I have a few pictures about that. But then we go for the general aspects of pair trading, because we need to know a little bit more how to deal with that. And we introduce the concept of market neutral trades, which is very important here, that we enter our trades market neutral. And the one or the other might have heard about market neutral trades already. That is a topic which plays a role, especially for big companies. They look for strategies similar to those, because they are not that risky. If you go for smaller time frames on indices, then we have another problem, so to say, and that is how to get historical data, for example, for DAX or FDAX and S&P 500, because our standard data source, which we use for, in most cases, like Dukascopy or stock, they don't offer very good smaller time frames. You can find them at Dukascopy, but you don't have that long history. Therefore, I introduce another data source for that. And you we can go backwards up to until 2010. And then the main problem comes when it comes to pair trading, because we want always to compare that or the one underlying with the other one. And the problem we need to solve is that the two numbers represent the same time. That sounds trivial, that you have two data columns with DAX and S&P 500, but you have to synchronize the rows that you have exactly in the same row, the exact time, the exactly same time, because we want to compare the two with each other, and therefore that has to be solved. And there's a nice Excel formula which helps us, and I will show that as well. And then, of course, we come to the final strategy of intraday pair trading strategy. The overall idea I just want to illustrate in a normal standard chart. In this case, I use, just for illustration purposes, an M1, so a minute chart. That was from yesterday morning. And what you have here is in the upper part, the DAX, and in the lower part, the S&P 500. Maybe not absolutely 100%, but for our case, it's sufficient enough. The two time scales are identical, and so that if you compare something vertically, you are always at the same time. But what does it mean now to have that pair trading strategy for those two indices? In general, what we can observe here, what we can clearly identify is the overall behavior of the two underlyings is strictly the same, more or less. Mathematically, that means they highly correlate. If the one goes up, the other goes up as well. And if the one goes down, the other goes down as well. That's a normal standard behavior. And that's absolutely typical. And if you put some other indices here in the same chart as well, then you would observe the same things. So in principle, highly correlated markets. Okay, understood. And we know that. But from time to time, we see some exaggerations, or we see that highly the correlation is not working 100%, and that might be even smaller details, but they will later trigger those pair trades. Let me start with one example here in the more or less in the beginning of the chart. If you look here for S&P 500, you see those three green candles going up. Okay. We have more or less the same situation. The middle candle is for DAX slightly red, but anyhow, we have more or less the same configuration within the DAX as well. But the DAX move has been much stronger than the S&P 500 move. And that later, we will do it mathematically, might trigger a pair trade. How does it work? If we realize in this case the DAX is moving too fast or too far to the north in this case, then it would trigger a short trade in DAX and a long trade in S&P 500. So and later we have to calculate that that kind of trade is market neutral. But what we aim for is that the situation comes to normal once again. And that means the DAX has to go south. Okay, the S&P 500 might go south as well. That would mean, finally, if we look to those two trades, the DAX trade will be a winner trade, and the S&P 500 trade will be a loser trade. But if we have had that kind of exaggeration before, then the profit of the DAX trade will exceed the loss of the S&P 500 trade. So we look for that deviation from normal correlation, and then we open the pair trade, and we open the pair trade market neutral because we don't want to care about the overall market behavior. So the general behavior might go north or the general might go south. We don't care. The important part is that we have had that exaggeration, that one was moving too far. Ideally, we would even find situations one goes north and one goes south at the same time. That would even trigger a pair trade much stronger. But even if we only have that kind of exaggerations, it is a good signal for an entry for a pair trade. Let me show you two other examples within the chart. And I put, by the way, an EMA into the chart because that helps to find, even by the naked eye, to find those exaggerations. Look for the behavior here. And you see it just by the slope of the EMA itself. But let's look for the details within the candles. You see, we have a strong move north in the S&P 500. Yeah, we have a move north in the DAX as well. Okay, but not that strong. Once again, now this would trigger a pair trade exactly vice versa. We would go short with the S&P 500 and long with the DAX. Once again, market neutral. And we hope that that exaggeration comes to normal once again, which is the case here. And if you have a feeling for that kind of behavior, you find even other situations within that chart here. You have a tendency here. The DAX is overwhelming the S&P 500. You see that strong move north and no move in the DAX, in the S&P 500. And all those kind of situations might trigger such a pair trade, because the situation comes back to normal, which is within the chart as well. We will later see that those moves, those deviations here are not strong enough in order to get profitable trades. As you know, we have always to cover costs as well. So that means we need at least to earn the spread. So those deviations within that chart here are not strong enough. That will turn out later. We get those situations maybe 4 times a month and not 3 times a day, because there are much stronger deviations like those examples here within the chart. But that comes out later. But you see the concept. Market neutral trades, we will discuss next. And the other thing is we look for exaggerations as a trigger for those trades. I shortly just want to have a look live how the situation is as we speak. And in this case, I have here M5 data for DAX and M5 for S&P 500, just looking whether we can find a specific situation as we speak. And indeed, it looks not that bad. It's much better than yesterday in the German webinar. Because what you can see in the EMA helps you here. You see that the EMA in the DAX goes north, and the EMA in the S&P 500 goes south. Wow, that's great. Because that means we are not correlated anymore, at least right now, within the last maybe 30 minutes. So here the situation becomes really interesting. And how would we trade? We would open a short trade on the DAX and a long trade on the S&P 500. So situation live doesn't look that bad. It's exactly wise to my positioning. But anyhow, we don't talk about the ongoing trades here. That's not the topic right now. So what we need when we open that kind of pair trade, that's a general thing. we need to open those trades market neutral, because we don't want to suffer. We don't want to get hit by any overall market behavior. Everything goes north or everything goes south. That should not touch us. Therefore, we have to open that trade market neutral. Up to now, I always said, okay, the one short, the other long. When it comes to trading, we need to open a specific lot size number. So maybe 3 lots DAX, and now how many lots S&P 500? That's a question. Because and you know that, a one lot trade S&P 500 does not equal a one lot long trade DAX. So they would not cover each other. Think about in percentage changes. Both go 1% north. And that is what we want to have. That if both go 1% north, then that market neutral summed up trade should not be touched anyhow. And that means we have carefully to calculate the lot sizes. And it's just an equation here. And it's not really complicated. It might look complicated, but it's straightforward. And on the left side of the equation, we have everything related to, let's say, underlying A. So we multiply the lot size, we multiply the price. Oh, that's still in German, sorry. Kurs is a price. The lot size of underlying A times the price of underlying A divided by exchange rate of that specific underlying. In case of the DAX, and my accounts are in euro, the exchange rate is simply 1, because the DAX is priced in euro. So we would not have that one here. On the right-hand side, we have the same calculation. Lot size of the other pair. So let's call it B, or later it will be the S&P 500, times the price of B divided by the exchange rate. And now it becomes important, because the S&P 500 is priced in dollar. So that's one part of why one lot S&P 500 is not equal one lot in the DAX. There are two elements: the price itself, and the other is the currency. And S&P 500 is priced in dollar, and the DAX is priced in euro. Let's go through an example how to calculate really practically the corresponding lot size for the S&P 500 trade if we want to open the DAX with fictive 2.3 lots. Okay, then we need the other numbers. We need the price of the DAX. Okay, 12,670. S&P 500. The numbers, by the way, have been from yesterday morning. Nearly 2,700. And the exchange rate euro-US dollar, which has been at 1.16. And now we can do the math. And it's really straightforward. So we multiply the lot size of the DAX trade with the price of the DAX divided with the exchange rate just 1. And then we divide everything by the price of S&P 500 divided by the exchange rate. So it's nothing else than to solve that equation here, which is really not that complicated, for lot size B. That's what I have done here. And doing the math means finally we have 12.5. If you do backwards now the two sides of that equation, you will realize it's nearly perfect. We will not have a perfect fit of both sides, and the reason is simply because we have lot size limitations and for those two indices, it's the step size is 0.1, so we don't have a 0.28 possibility to open trades like that. So, but that's fair enough here. So now I know If I go for a DAX trade 2.3 lot and an opposite trade with 12.5 for S&P 500, then I have a market neutral trade. I repeat myself. What does it mean? If both prices just go up by 1%, then the summed up trade would not have any difference. So we would not lose any money, because what we gain from what we profit from the one, we would lose from the other. And that's the concept. And you realize now, what does it mean going for pair trades? It only makes sense if we have that deviation from normal, because then it's a good point in time to think, hey, it should go back to normal. And therefore, we open the trade market neutral. The combined trade itself does not have a stop loss here. Because practically it's difficult to set just from the MT4 logic, because you would have to sum up the both trades. There's definitely it's not a good idea to have a stop loss on the individual trades, because then one would finally end up in the stop loss, and then you don't have the pair anymore. But it's okay. The risk is not that high. If you want now to really investigate at what kind of exaggerations, at what kind of deviations we should open the trades, we need historical data on smaller time frames. And that's indeed not that straightforward, I can tell you. Therefore, I spent one slide and one Excel sheet just for that topic here. And I will show it a little bit more practical here, how we can synchronize the data. So the first thing is, as I mentioned, we switched to another data source, and it's www.histdata.com, and I show the website in a minute. And I mentioned already now, when you go for those data, they have a different time zone. Those data are in the time zone New York, so 6 hours difference at least for Germany. And there are 2 time periods in the year, one about in March and one in November or October, I forgot. When we have the summertime, then we have small the change from summer to winter time, and vice versa. Then it deviates a little bit more. But anyhow, the good thing is, if you go for that data source, both time frames are identical. So the timestamp of every source, of every price, is identical, and that's exactly what we want to have. But the problem comes from that S&P 500 has more data than the DAX, which represents, in this case, the FDAX. So, but that is what we have to make sure, that we have the same data. Let me show you how it works with his data. So that's the website of hisdata.com, and you don't have to pay anything here, so it's free of charge. You can just download those data. But there's one thing I have to mention because that is really funny. You get data on M1 base, so minute data for indices, which is really cool. But everything starts, of course, with Forex. You can have Forex data there as well. But if you want to have indices, then please look on the first page here, because they use really weird symbols. And the S&P 500, for example, has a name SPX USD, or the DAX has a name GRX Euro. So it's a little bit funny, but if you know it once, then you are fine. And then you can download the data, and it's looked like the following. So we go for download of data, and then you can even choose, and that's something I want to mention here as well. For example, if you have an India trader, just another trading platform, you can already download the data directly for that platform. Which is cool as well. And what we do is we go for MetaTrader data, and therefore M1 data. that you just have a feeling of how it looks like. I do it here. So let me go for example SPX USD, which is the S&P 500. And then you can see you get zip data here for the different years, and for the actual year, it's per month. Let me just download once here that you see how it works. So we download the data, and then let's have a look here for the data itself. And here we are. And just I open it with an editor, because then you see the structure of those data, and you see we have it starts with a date, and then it's the time, and then open high, low, close, and there's some indication of volume, but I think that doesn't work because it's always a zero. Once again, those data are M1 data, and they are on New York time. So it's really cool to have that kind of data source. But we will later see that there are some data missing, some minutes are missing. And you know that the FDAX is in German time open from 8 to 10 p.m. and the S&P 500 has some gaps in the night. There are two time gaps in the middle of the night. So they are not identical. And now it comes to let's get them synchronized. Let me show you what I mean and how I do that synchronization of the two data sources. Here we are. Let me enlarge it a little bit so you can see the logic. The first I put is, you see, you can imagine those data here are DAX data, 12,000, starting at in January this year. You see already what I have done. I have summed up the first two just to have a single column with the date and the time as one number. Okay, done. That's straightforward. And for whatever reason, the data started at 11:35. Oh, I have to mention that I first converted the data from M1 to M5 because I don't want to have the number of data should not be too heavy, too high. Therefore, I reduced from M1 to M5 to 5-minute data. Then I copied the same for S&P 500 next to it. And now you see that misaligning. So the S&P 500 data start at 9:45 and my DAX data at 11:35. Okay, I could delete everything here in the S&P column down to here and move the rest upwards. Okay, but then later comes the next gap or misaligning of the two data. It would be a nightmare to do this for a couple of years, and you could spend weeks or even months with that task. But now comes the trick. You see, I have a new column here. Oh, it's just a copy of the date, because my reference data I aim for are the DAX data. I know the DAX has a reduced data set in German time from 8 to 10 p.m. I have more data for S&P 500. So I want to use the DAX as a major pair here, or the major index. And now I want to have in the same row the corresponding data from S&P 500. So that means here for 11:35, I want to have exactly those four numbers next to it. And you see in the first row, I have achieved, because there we have exactly that four numbers. Let me turn it a little bit more to the right. And the cool thing is you can do it with a single formula. And all you need is that kind of formula. I don't want to go into the details, but it's more or less in the sense like please search for that time, the time C1, which is the same here. Search for that time within those data from S&P 500. And if you found the right time, then please remember the line number, and then it comes to the copy of that that number from that specific line. And that's everything we do. It's something like search and insert, and that you can do with a single line, a single formula within Excel. And then you just have to copy it downwards, and then you have the data exactly synchronized. So that means within one line, I have starting here the DAX values and the corresponding values for the S&P 500 as well. That's the source we need for investigation of our trading setup, pair trading. That's exactly what we need. We have them synchronized. Of course, we will delete all lines which are have no numbers, like here. For whatever reason, we don't have data for 1220 for S&P 500, and then I do a simple step. I just say, okay, then delete the complete row. So just forget them. And then I don't care about that. It's not that often. We have some cases, yes, but later here you will see no problem. Okay, that's to synchronize the data for pair trading, and it's extremely important. And even if you do pair trading on other time frames, even on D1, you will realize if you have downloads for two underlyings that some data are missing. Maybe the one is not traded on a day on holidays or special days in the year, and the other is traded. It's a nightmare to get them synchronized. Synchronized meaning in one line of Excel, we want to have the same time frame, the same timestamp for both data. So now we know how to organize the data. That's good. And then we can go for the pair trades itself. But first, let me describe how it comes to the trading strategy. Now we have to translate what I did within the chart to a strict logic for entries and exits of those trades. We need to define what we mean with exaggeration or deviation from normal. That are nice words, but we need them a little bit more mathematical because we want to simulate that kind of trading approach. And how we do it? The first thing is, I forgot to mention it in a single line. We calculate the ratio of the two underlyings. That means simply the quotient. So dividing DAX price at the same time with the S&P 500 price at the same time. And now you see why we need that synchronization, that we have the data in one row for both underlyings. So we simply build the quotient. The quotient is about 5. Okay, so that's a ratio. Some people do not call it pair trading, some people call it spread trading, and some people call it ratio trading. Anyhow, everything means the same. The next thing is we apply an EMA to that ratio. And if you, by the way, if you want to do it really in a chart, then unfortunately you cannot do it in MT4, but there's a software which is called Trade Signal, and that can do the job for you. And then you can do the ratio in a single chart, and you can apply an EMA to the chart as well. Okay, done. We apply an EMA to that ratio, and now we look for something we did within mean reversion approaches as well. We look for the deviation from the actual ratio to the EMA on that ratio. And if we have huge deviation, then we call it a special situation. Then we have the non-normal situation, the exaggeration. Maybe one underlying went north, the other went south, or both went north, but one much stronger than the other. And then you will realize that automatically by that deviation of the actual ratio from the EMA on that ratio. Now we know that one symbol is, with respect to the other symbol, more expensive, and we know exactly which one we go short and which one we go long. The too expensive one, the one which went, for example, too high north, that is traded short, and the too cheap one is traded long. That's the idea. So the entry is now defined when we exceed a certain deviation from the actual ratio to the EMA on that ratio. That triggers the open of the both trades. Next question, when to close? Quite easy. We do it when the actual ratio crosses the EMA once again. That will be the close. You will see in the next chart exactly what I mean. And that are the two things we have to know: entry and exit. Good. But now let's go practical within that Excel sheet, which illustrate that kind of logic. Let me first, before we go for the nice or the equities, how I do here everything. You see, of course, once again, the DAX data, and that Excel sheet I show here is only the first 4 months of 2018. I have another one including the data of 2017 completely as well. But as you will see, we have a huge number of data. Already those 4 months represent 11,000 rows within the Excel sheet. And so I do everything in that smaller Excel sheet only because then it's easier to be handled. So we have the data, timestamp, and then open, high, low, close. And we have the same for the S&P 500 data. And in a single row, we have the same timestamp for both. Then we calculate that ratio, which is really the one divided by the other. And we calculate that EMA, you know the standard formula for calculating EMA, and we can later change the EMA period here. Of course, we calculate the difference of ratio minus EMA, and if that will exceed a certain threshold, then it triggers our trade. But in order to illustrate a little bit more what does it mean here, I go for this chart in front of everything else. For the first 1,700 data points, I use this chart. The other one is here. That's representing. Let's start with a complete picture, and then we go for the zoom in function here. So what we have here is for the complete data set. So the 4 months of 2018, we have that ratio in blue and the EMA on that ratio in red. What you can realize that for the first 2.5 months, the overall trend of that ratio is going south. What does it mean? The overall trend of the ratio goes south. That means if I divide DAX by S&P 500, the S&P 500 is stronger than the DAX because the ratio is getting smaller. Think about you make one of the two constant, then you can immediately realize, or you can answer the question, who is stronger compared to the other. the DAX or the S&P 500. In this case, the ratio is getting smaller, and that means S&P 500 is stronger than the DAX. And then it changed the overall behavior completely, and now it goes north. Okay, that's the overall picture. But that's not what we want to trade. Therefore, I zoom into that kind of picture here. And then let's go for this at first, so that you can a little bit better understand what are the entries for that strategy. You see, we have the EMA on the ratio, the red line, and then it comes at a certain level that we have a huge deviation. And in here, the deviation for the first 600 data points, the deviation of the actual ratio is the highest from the EMA. And that might trigger our trade. And that is simply done here within the Excel sheet. If we exceed a certain threshold, then we open the trade. And in this case, it would be a short trade on the DAX and a long trade on the S&P 500 because everything happens above the EMA, and it would be vice versa. Maybe here at that point in time, we would open a trade exactly vice versa. But when we have opened the trade here, when do we close the trade? When we hit the EMA once again. So we would have been invested from here to here, which is not that long. It's about just 1 day. That's about 205 candles. That's about 1 day. So it's not a long time, long-term trade, but it's a profitable one because it went back to normal. And that's all. That's the way we do. All the rest is done within the Excel sheet here to get everything calculated. And I don't go to the details, but you can have the Excel sheets here if you like. That we open the trade, we store when we open the trade at what price, and then wait to close the trade. And everything goes further here, but let's not go into the Excel details. The only thing I want to mention is everything which comes up here to the right, please forget. That was something from a previous webinar, and we don't use it for those Excel sheets. I simply forget to delete everything before, and so just when you have that, everything to the final right is not useful anyhow here. But now it comes to the good thing. Now we can change. We have only 2 parameters, the EMA period and that threshold value for the distance to open the trade. So a 2-parameter strategy is always good because the less parameters, the better. In this case, the parameters are already quite well, but I will show how to improve it even further. So we can change the EMA period, and then we can look how the equity will finally change. Equity, I have to explain a little bit. Originally, we have always 2 results for each pair trade. We have a result for the S&P 500 trade, either long or short, or the DAX trade, either long or short. And what counts finally is only the yellow curve, because we have to sum up the both trades. Right now, and you will see in the next Excel sheet later, the profits stemmed here for those 8 trades, they stem from the S&P 500. Most of the DAX trades has been loser trades, but it's always with pair trades that you have one loser and one being the winner. The important thing is that the winner profits more money than the loser loses, which is the case here. And we can change EMA, we can change that multiplier, but what we can do as well is we can do it automatically. And that's what I want to share with you as well. And maybe just to mention it, I do always everything in this called LibreOffice, which is an open source variant of Excel. But unfortunately, if you want to use that automatically optimization tool, then you need to install Java, and that's what I don't want to do, and therefore I go for Microsoft Excel. So, but only that's the only thing I do in Microsoft Excel. And what you can do here is you can just optimize it completely automatically. You need one single value which you identify to be representative for the overall strategy. That's a certain number I calculate here. And then you just go to data and then solver, which has to be installed first, but it's free of charge. And then you see already the logic, even that is in German, but just to illustrate the logic. That number should go for maximum here by manipulating, by looking, by varying the two values, the one for EMA and the other one for that threshold value. And for the two values, you identify conditions, side conditions for minimum and maximum, because you don't want to have negative EMA values, for example, or you want to have negative thresholds or something like that. And so you need some suitable numbers, being the lower limit and the upper limit. And then you just pressed solve, and then the computer is doing the rest. I have started that exercise already. It sometimes takes just an hour to get it done. But I have done it already. And then you turned out those are the best parameters. And I go straight away already for the other one here, which is having more data. That is now 2017 and 2018. And you see the yellow line here, which is the final equity curve. Doesn't look that bad. And you see I have got the parameters just by applying that solver logic from Microsoft Excel, and it's not that bad. I have to mention that it's very important for those kind of strategies to include the spreads. Without the spreads, you will find even much better situations, much higher profits. But of course, we need to incorporate spreads as well, because otherwise we are lying ourselves. So we get not the right numbers. Strategy is really cool. It's not that many trades. It's about 1 or 2 trades a month. Only when that kind of deviation from normal is really high enough, then it's a trigger for a pair trade. And within that time period, you see that's not always that the profits come from the S&P 500. We have other situations here as well. The good thing is yellow line goes north, and that is the final equity for that kind of strategy. So it works well. Now, the reason why I have not already going down for data starting at 2010 within Excel is simply too many data. This is already 40,000 rows, so Excel is getting slower and slower. So next step is to do it in self-written C programs, and then I can do that kind of job and optimization even for a longer period. But I'm already convinced from that kind of strategy. Even looking for the right entry points within the day. And I know that we don't have the problem if we go for a D1 based strategy, which does not work for S&P 500 versus DAX. This one here works, but still we don't have that many trades. But it's fine enough. Good. So that's the overall strategy. That's the logic, and you can do calculations by your own if you want. Just send me a note that you want to have those Excel sheets. I will not directly send them. It will be a link once again to a Dropbox because the data size is in the range of 20 megabyte per sheet. So that's nothing for email. So it will be just a download link. So I can go for my summary for today. So in a nutshell, pair trades, it's always important to remember pair trades are market neutral trades, which makes them quite interesting even for bigger investment companies, but only if we are in a situation of being not normal, being in an uncorrelated state, being in a deviation state. And those one we can identify even on smaller time frames by looking for the ratio and then comparing the actual ratio to an EMA on that ratio. And if that deviation is exceeding a certain threshold, then it's time for us to trade. And the trade itself is once again market neutral, and we go for the idea that the market comes back to normal. The trade frequency, even if we start our trades on smaller time frames, is quite moderate. But I have expected something like that even before I start investigating this strategy in more detail, because the strategy or just looking for the costs of trade, it can't be that you can get that much money every day with 20 trades on those two pairs. It cannot work out anyhow. So trade frequency is still quite moderate. And of course, we can investigate other pairs as well and other indices to be compared. No problem. And it's now straightforward with those Excel sheets to do that kind of investigations as well. Once again, if you want to have those, just send me an email. Unfortunately, I cannot put them for download directly here within the GoToWebinar control panel because I'm only allowed to have their PDF documents. I assume that's because of virus and something like that, but I don't know exactly. You can get them, and that's a good thing. Okay, that's for today, but let me mention already that the webinars for June are already on plan, so you can find them already on the event page of JFD, the JFD website. And the two webinars I do in June is one will be related to real stock trading, which is of interest for a lot of people, to look for real stock trading, not CFDs. No, we trade real stocks, just buying Apple or buying, I don't know, Goldman and Sachs. So a different kind of trading style for going for real assets, real stocks. And the other one is related to something we did already similar. You remember we have that DAX day of week strategy, looking for the right times for of a day, and I've done some work on that in order to get a quite good strategy similar to the DAX day of week strategy, and there are even more to come with similar logics, different underlyings, and it's quite cool. You will see. Okay, that's for next month's announcement for those two webinars. I hope that you will find the way to those webinars as well. And for today, have a nice evening. The only thing I can say right now. So enjoy your evening. Bye-bye.